smart money. So just take your profits and step aside. All right. Next stock I want to mention, and this is a trade. Okay, so at the end of there's a trade, and so I need you to be prepared for this. I need you to buy something going into earnings that's going to be coming up in a couple of weeks, and that stock is VALE, V-A-L-E, symbol V-A-L-E. It's a $9.92 stocks. Okay. And this is an iron ore producer. This is a $50 billion iron ore producer from Brazil, and basically, I think that this earnings report that's coming up sometime, when is it, on February 23rd before market opens. February 23rd, before market opens, is when the company will be announcing earnings, and I believe you're going to see a fantastic quarter from VALE, and that I think the stock is going to make a run going into earnings and is going to break out potentially after that through this $11 resistance, this new to a new 52-week high. So I'm looking for more than 10% move in the stock from here. It's just a $10 stock. You can just buy the stock if you like, or you can buy call options, which I will recommend later. All right. So first, from a technical standpoint, you can take a look at this chart. It's a beautiful trend. I understand that on a percentage basis that it may seem like, oh my God, this has run quite a bit. You know, I mean, just 4 months ago, this was at $6 and now it's at $10. So yeah, on the percentage basis, sure. But you have to stop looking at where it came from. Take a look at what's happening in the future and if there's more upside ahead. And I think you'll see that the picture is even brighter than what we have seen so far. Beautiful trend, goes up, pulled back into year end, ripped higher, and now it's pulling back again. And I think this pullback is presenting a buying opportunity. To show you the same picture but differently, let me pull this chart from stockcharts.com. Give me 1 second. Okay, that's interesting. I thought I had. It seems to be. Here you go. Here's a chart. Where did it go? Nope. Okay. I obviously did not save that chart either. Hold on a second. I'm going to create another one. Seems to be losing my mind today up here, apparently. And I thought I had a lot of sleep, so I was doing better. Okay. So here's the chart from the from stock chart. The reason why I want to bring this up from here is because of a particular support levels that I wanted to show. So here is, first of all, this is your trend support. And notice that basically if I simply connect the dots, it comes into here, right here, around $9 a level. And this level basically corresponds with the 50-day moving average, which is also at $9.02. But a more important level, which aside from just the trend supports, is here and here. Okay, so basically you have a small pullback, give or take a little bit, but basically it pulled back to this $9.50 volume of price support, and it's starting to bounce off from that. If it does sell off, there are 3 layers of major supports that are coming into play, and I believe that's going to support the stock, which is right here. So you got between 890 and 9. So I understand on a percentage basis that is still pretty low, because with stock at 990, that means that the stop loss on this that you're going to put on is going to be like almost $1 stop loss below current price. But that's how it is with Brazilian stocks. They seem to be very, very volatile, and so they move so fast that percentage basis, you have to leave a pretty big cushion on the stop loss side. But anyways, there's massive support under the stock. I think the stock has pulled back to a point where it can start to form a constructive flatlining process, and then I think it's going to move higher, and it's going to run back towards $11 a level. All right. So that's basically the technical view on the chart. Next thing is the option side, and so this is what I saw in stock today. Somebody came out this morning and they bought right here. You'll see that they bought 19,000 of June 11-13 call spread. 19,000 June 11-13 call spread, and that's with stock trading under 10 right here. So this is 11, 13 call spread. So they see this stock going above $11 per share, okay, by June expiration. So that's a pretty good size move over there. And they bought this 19, 13 call spread, 19,000 of those. This is an $800,000 bullish bet on 2 times daily average call volume. I think it's significant enough to get my attention. Now on the fundamental side, all right, again, as every time when we do these trades, we evaluate every single thing based on fundamentals. I want to show you something that caught my attention, and once again, this comes from Bank of America. Here's a file from Bank of America that I saved from February 2nd. And there's a comment in this that caught my attention, and I was waiting for the right moment to bring this up, and I think that moment has finally come. This is from February 2nd, and it says that all eyes are focused on how iron ore will behave after Chinese New Year. Remember, last week was Chinese New Year. The whole week, market was closed in China. All right, it was a week-long celebration of Chinese New Year. And so on February 2nd, which was over the weekend, Bank of America said that, this is about VALE, and it said that all will depend on how iron ore prices will move from here after the Chinese New Year. Also, in the same note, the comment that caught my attention was that they believe that currently VALE stock price is based off of $54 per ton iron ore pricing. Assuming all else equal at the spot price, every $1 increase per ton on the iron ore prices will increase the net present value by 7%, which means that only $1 increase equates to 7% upside in the stock price itself. 7% upside in the stock price itself. And it also says that this is a massive number. I mean, I was surprised to see this. They believe that at the current spot price, we estimate VALE generates $21 billion in EBITDA in 2017 versus $13 billion consensus. When I read this, this is sort of the kind of a note that when I see consensus, when an analyst, somebody like Bank of America, that puts it in lamest term, purely based on the underlying strength in the iron ore prices, this is the sort of note that caught my attention when, just to kind of give you a reference point, that when NVIDIA many months ago, like in early 2016, NVIDIA was projected to see only $1.50 EPS for 2016, and Bank of America came out that based on what we are seeing, they're going to do $3 EPS, like double where the street consensus is. Or when Morgan Stanley came out, before Freeport McMoRan, FCX went completely parabolic, and I showed that chart in the chat room. And that note from the chat room, and on Freeport McMoRan FCX, Morgan Stanley said that based on where the copper futures are, if copper futures simply even just sustain this value, we believe that the Freeport McMoRan could earn 40% above where the consensus is. I mean, these are not rocket science. They're simply based on the underlying strength in the commodities, and based on those kind of things. This is here being Bank of America talking about VALE, that hey, consensus think it's going to be 13 billion. We think it could be as high as 21 billion. And on top of it, on every $1 increase in iron ore prices, $1 per ton increase, we think that net present value will increase by 7%. But much of it will depend on how iron ore prices will behave after Chinese New Year. So what happened after Chinese New Year? Well, here's what happened. This is an article from Business Insider. Okay, this was on February 8th. February 8th was yesterday, and it says iron ore just suddenly spiked. Iron ore prices just suddenly spiked, and it goes on to show what happened. Okay, this was one day after Chinese came back from the New Year. It says that it's now wild, as demonstrated by the daily gyration. And then it goes to say Tuesday was no exception. Out of nowhere, and after 2 days of heavy losses, prices exploded higher, led by another enormous move in Chinese future. Hey, so it seems like the Chinese were ready. As soon as they came back from New Year, they did not care. They just wanted to buy iron ore. And here's a chart from Business Insider that confirms that. So basically, this was a sell-off that they were talking about that happened before you know, that happened when the Chinese were basically on vacation on New Year, and then it came back and a big spike. By the way, this morning iron ore prices are continuing to march higher. So this chart is as of yesterday. Today, if you look at the real-time prices, iron ore prices are continuing to move higher. Iron ore prices are actually breaking out through this $84 per level today. And overnight, based on the strength we are seeing in the commodity complex in general, particularly in the crude oil market, and they all seem to tend to move together, I wouldn't be surprised if iron ore prices are even higher tomorrow and potentially even next week as well. So based on all of this, it basically is telling me that Bank of America catalyst is playing out as they expected. So it's no surprise that somebody came in and took advantage of it, and they bought 19,000 of these June 11, 13 call spread. So bottom line is this. We got a beautiful chart making higher highs and higher lows. It has pulled back recently. It's down 10% from its 52-week high. We have a big bulk stepping into June calls. And we have a fundamental technical picture that makes a lot of sense. All right. And here's a full file just to let you know. By the way, this was I was saving it from February 2nd. Okay. And so here's the full file. I will share that in just a moment. So based on fundamentals, technicals, and unusual option activity, the trade here is pretty simple. All right. You go out to June, okay, and buy in the money, 9 calls, June 9 calls for $1.63 or less. Okay, I want to go with high delta over here. With stock already trading at $9.90, buy in the money June 9 calls for $1.63 or less. The bid and ask currently is $1.59 to $1.63. Okay, just buy right in the money. This has a delta of 0.67. Why am I recommending? No spreads, by the way. Do not do any spreads in VALE. Just buy straight calls. Why am I recommending in the money calls? Well, first of all, they give you high delta. Secondly, I always look at the value of options relative to the underlying price of the stock, because it tells me how expensive they are and whatnot. And quite frankly, for example, if you know, these June 10 strike calls, you know, would be $1, and then $1 as a percentage of a $10 stock, that's 10%. That's too expensive. That's 10% for something that's out of money. And for if I go even further out of money, or even if I were to recommend as a spread, I mean, you know, it's like June 11 calls would be like 70 cents as a percentage of the underlying. This is almost 20% out of money calls, and it would cost, you know, 7% of the underlying, and I think that's too expensive. So I want to go with in the money, because in this case you'll be spending about 70 cents extrinsic value with a high delta. So even if I'm going to recommend something that I'm still spending 7% on the extrinsic value of the option itself, at a minimum, I want to be compensated for it by going with high delta. So it mimics the stock very closely, and that's the logic over here. Okay, so even these June 9 calls are not cheap. They're going to cost you about 7% of, like I said, 7% of the extrinsic value as a percentage of the underlying stock price. But at least you're getting a very, very high delta, and you have 127 days to work out. Now, ideally, to be honest, I'll be very clear about this. I would have recommended April if it was available. See, in my opinion, March may not give you enough time, okay? Because I still have to take into account the simple fact that that there might be a small chance of some equity markets weak seasonality that will come into play, and then we'll be caught on the wrong side if we go with March, because we're going to be playing with fire, with theta decay going against us. All right, March frankly doesn't compensate for the risk, in my opinion, and April is not available, May is not available, June is the one available. That's why I have no choice but to go with June. Go with June 9 calls, buy those calls straight for $1.63 or less, all right, and hold them into earnings, which is going to be sometime on February 23rd. And later on, when the stock rips higher, you can then potentially convert this into a diagonal call spread by selling maybe March 11 calls. Once the stock breaks out, you might be able to sell these March 11 calls for like 40 cents or something. Right now, they're going for 23 cents. I think you'll be able to sell these for like 40, 50 cents, and then and then get some very good payback against your long calls on a percentage basis. All right. So that's my play for today. Now let me pass this file. Just give me 1 second.